Welcome back. There is a recovery that we're seeing in the broader markets, especially in some of these beaten down names, right? So names like Affle, Dixon Technology, InfoEdge, Deepak Nitrite, Persistent Systems, all these stocks are down anywhere between 20-25% this month. But today, there's a recovery of around 3 to 4 odd percent. So come back, so to speak. But let's move on. Lata is here with us with the key takeaways from the RBI annual report. Lata, what do you have?
Well, actually, everybody was intrigued why the Reserve Bank gave a dividend of only 30,000 crores and not 99,000 crores, which it declared last year. Even in the budget, what was put against the RBI was actually 78,000 crore and change. But why only 30,307 crore? And what you got here is actually the reason. One, the Reserve Bank has been spending more. It paid more because there was a lot of reverse repo transactions that it had to do to absorb the money, excess cash. If you look into the fine print, is 35,000 crores plus. Last year in reverse repo, they had only spent 17,000 crores. So that higher expenditure was there. But the biggest reason why they could not declare a dividend was they had to put more money in the contingency fund. Now, what is this contingency fund? The Bimal Jalan committee said that whatever your balance sheet is, 5.5% of that has to be the contingency fund. Now, RBI balance sheet expanded. Why does it expand? Because they printed more notes. They printed more notes. Why? Because they did more OMO. They bought government bonds and they bought dollars. So their balance sheet has increased by 8.46%. For that increased balance sheet, the balance sheet also increases because you revalue gold, you revalue your dollar reserves. All that together increase the balance sheet, and therefore they had to keep a higher contingency fund of 1.14 lakh crore. Last year, the same amount was only 20,000 crore. And that is why, from their income, that much was deducted. So they paid a lower dividend. And the table will run for you. The total income, as you can see, against 1.33 lakh crore, their income has increased to 1.6 lakh crore. That's because they're holding more government bonds, Government of India bonds. They bought a lot of bonds. The interest on that comes as income. Expenditure is more or less the same. The biggest expenditure that they have, those are the income, subheads. On interest income, they made 95,000 crore because they hold more Government of India bonds. Other income is, they sell FX. When they sell foreign exchange, the cost is seen as what they acquired over the years. The cost is less. And when they sell, they make money. So that is the profit. It's more or less the same in both years. The balance, the biggest outgo is that 1.14 lakh crore provisions I told you. Last year, it was only 20,000 crore, as you can see, and hence the lower dividend. So this is the big thing you get from the annual report. But there is always this long commentary on state of the economy, state of budget, central government finances, state government finances, banking system. Over there, we have some interesting takeaways. The governor is repeatedly giving us his view of the state of the economy. So there's nothing earth-shattering over here, except that there is an admission, when you look at the high-frequency indicators, that there is a loss of momentum in the recovery. From a market point of view, I would think that that observation from the central bank is important. Also, there are some observations on state government finances, which we don't look at very often. It's a very positive comment that the central government has devolved more money than was expected of it, and state governments have spent more on capex. Both these are positive comments coming from the Reserve Bank. Well, that's what I could glean from a very quick read. There's lots more to read. But let me get to the expert. Indranil Pan, the chief economist from Yes Bank, is joining us on the phone line. Indranil, any surprises on the dividend now, or are all doubts clarified?
No, I think the way you have clarified the doubts yourself on the channel, I think nothing needs to be explained any further. Okay. You are right in the fact that the expenditure component, the biggest increase has been in terms of the contingency fund, which has been retained at 5%. And that's the increase in the contingency fund that was seen, which has accounted for a relatively lower profit and a relatively lower amount that they can share with the Government of India.
Okay. I might just tell you, Indran, for the benefit of the viewers, you would know this. There was some debate whether Reserve Bank would say only for 1 year, let us not keep 5.5% because this is an unusual year, and thereby transfer a larger amount. There was a lot of debate on whether RBI would do it, and there were some people who said for the credibility and the independence of the Reserve Bank, it should not do it. Probably those people have won. A possible reason why RBI did not transfer a larger amount could be because it is anyway draining liquidity. You know, how do you transfer dividend? You actually print money and give. Why would you print extra money when you are in the process of actually taking out liquidity through various ways? And therefore, that could have been another reason why the Reserve Bank did not change the Bimal Jalan or challenge the Bimal Jalan formulation and paid the higher amount. Indranil, any observations on, their state of the economy comments? At least what stood out for me is that high frequency indicators are pointing to some loss of momentum. Is this new news? Would you take it negatively, or is that well discounted?
To a certain extent, it is news in the sense that the read of the MPC commentary in May did point to the fact that relatively the economy is getting better, along with inflation also being on the higher side. And that's the reason why they are possibly shifting their focus on inflation containment rather than continuing to support growth. So this is definitely to a certain extent a deviation from what we heard just about a month back or less than a month back, and may have a lot of truism in it. Simply because of the significant increase in the commodity prices that is likely to have an implication in terms of the profitability of the listed companies, and that along with the fact that inflation is higher and consumption therefore will be depressed, could actually lead to a relatively lower number than what the RBI had been expecting at 7.2%. So I would expect a revision downwards in terms of the GDP as the RBI meets in June for its monetary policy. Okay.
Oh, then that is important. Well, I guess all my co-anchors here will testify that there has been a pressure on margins because of higher commodity prices, and that the RBI also says that elevation in crude prices, metals and fertilizer translated into a terms of trade shock. So, and then they go on to say the high frequency indicators are showing a loss of momentum. Just one more question, Indranil. What stood out for me was the positive comment on state government finances. Do you agree, or is there anything else that you want to point to?
No, I think it's a fair comment, and even in the union budget, there will be a transfer out of the capital account of the central government, 1 lakh crore, to the state governments, earmarked for capital expenditures of the state government. Undoubtedly, the capital expenditures of the state government, as per research by the Reserve Bank of India themselves, has a relatively higher multiplier effect, and the impact of that the higher expenditure by the state governments on capex also tends to linger on for a relatively larger period of time than by the central government. So this is definitely a positive comment, and this is possibly the only way we might actually see a lower line in terms of the GDP numbers. And this is something that can actually help us hold on to a certain level of GDP, given the fact that consumption demand, which is the mainstay of the economy in terms of the proportion of GDP, that is unlikely to go very significantly higher.
Okay, that's important. That's actually a big positive if investment has improved. Thank you very much, Indranil Pant, for joining us. I just wanted to point out, from a stock market point of view, they make some comments on banks and NBFCs. Banks, the comment is positive, lowest ever NPAs. But on NBFCs, please note, balance sheet of NBFCs expanded, but asset quality deteriorated.
That's what we heard from the managements, the earlier managements.
You heard
Sundaram Finance was talking about that there is deterioration
you can see evidence
in quality.
in the likes of Piramal as well, which is reacting to its numbers today. But nonetheless, that's the update coming in from Lata with regards to the RBI annual report and the key takeaways. We need to take a short break now. We'll get chatting with Sandeep Sikka, the Chief Financial Officer at Hindware Home Innovation, once we're back. Stay tuned.